Is it possible to make profit by scalping the Forex market for 5 minutes only if you know the top 3 candlestick patterns and how to use them correctly? So in this video, you will learn about these 3 candlestick patterns and how to use them correctly in order to make your trading more successful. If you take everything off your charts, you are left with a simple candlestick chart. What you're seeing on the screen is the raw price data, which traders refer to as a naked chart. And when it comes to Forex trading, it's no secret that candlestick patterns are extremely effective indicators for predicting significant price movements. They are a highly powerful part of technical analysis, and once mastered, they have a potential to deliver more accurate results, making them ideal for learning Forex trading. So no matter if that's a continuation or a reversal signal, this set of patterns may easily provide you with a heads up about what might be coming up in the next few minutes and help to make rational and correct decisions based on it. And trust me, they are suitable for traders of all levels of experience and can be applied to any time frame, but in this video I will show you how to implement the top 3 patterns when scalping the Forex market in a 5-minute time frame. After seeing this video, you will be able to precisely spot these candlesticks in the market and determine if the market is providing you a bullish, bearish or continuation signal to enter and bank some pips. So let's go through the major candlestick chart patterns I want to share and how to use them as effectively as possible. The first candlestick pattern I will show you is known as the shooting star pattern. I'm not sure why, but this candlestick pattern is so undervalued in my opinion. When I'm scalping the market, even for a short 15 to 20 minute trading session, finding a shooting star candlestick is like winning a jackpot. This one bar pattern is formed during an uptrend, and it indicates that the buyers tried to push the price much higher but failed, and the sellers enter the market aggressively. And in most cases, the price is being pushed back down to near the opening price, resulting in a long upper shadow being created. So here's an example of how to identify a shooting star candlestick pattern. It is necessary to have an established current uptrend in place in order for a shooting star candlestick pattern to be valid. This indicates that market is in an uptrend and the bulls are in control of the market's direction. The length of the upper wick must be twice as long as the length of the actual candlestick body. And in most cases, the absence of a lower wick or the presence of a super small lower wick is both indicators of a potential reversal of the market trend. So because of this, traders should consider taking a sell position once the bearish pattern is confirmed. So how to trade the shooting star candlestick pattern successfully? Well, the candle pattern may occasionally be incorrect on its own. However, the shooting star candlestick pattern has a tendency to appear near a resistance level or a trend line, providing further confirmation of the new bearish bias. So this is due to the fact that a single candle does not have a significant role in a broader trend or market movement, and you should always keep in mind that extra confirmation is required, by which I mean additional technical or fundamental justification. On a 5-minute chart of the GBP USD currency pair, we are seeing a trend towards an upside. The price is clearly making higher highs until the point over here. We are seeing some sort of resistance going on, even though we did get a bullish engulfing candlestick to show potential for the pressure up, but a shooting star formed below the defined resistance zone. So now let's cover how to enter and exit a trade based on this candlestick pattern. Of course, aggressive traders can enter on the market with a sell position immediately, but other traders may wait for the opening of the next candle. And I think every trader should be aware that it is common for the prices to experience a few pullbacks before starting a new trend. So in my overall experience, the safest place to place a stop loss is above the wick of the shooting star candle, which is also the candle's high point. The height of the candlestick represents the price rejection point, and it's also the point at which the price is reversed. To calculate the take profit, the shooting star pattern provides clearly defined levels. It's very common for the take profit to be 3 times as long as the shooting star candle, so traders can measure the length of the pattern candle from the low to the high price, which includes the candle wick and real body. So in this case, we have 7.2 pips as the target based on the whole candlestick, meaning we should aim for at least 20 pips in a profit. So let's play a replay tool and see how the trade develops. As we are seeing bearish power in the market, pushing the price towards the downside, point and reaching our target of 20 pips. Of course, you can move your stop loss to an entry once 50% of your trade is reached. In that case, you will have a risk-free trade. So moving forward in our top tier list, we have my favorite bullish engulfing candlestick pattern. In the Forex market, a bullish engulfing candlestick is probably one of the most recognizable price movement signs. Many traders will utilize this candlestick pattern to identify price reversals or continuations to support their trading strategies. So the bullish engulfing candle appears at the bottom of a downtrend and suggests an increase in purchasing pressure. A reversal in a trend is frequently triggered by the bullish engulfing pattern as more buyers enter the market and push prices further higher. In most cases, the pattern involves two candles, with the second candle completely engulfing the body of the previous red candle. It's like a Pac-Man swallowing cherries, and I probably couldn't come up with a better example, but at least you will remember it. So here's an example of how to spot a bullish engulfing pattern and how to trade it effectively. So I have GBP and ZD as an example. We are seeing a nice trend towards a downside with the multiple rejections, clearly indicating that sellers are in the current market. However, we are starting to see some bullish pressure coming in. These three candlesticks are called three white, well in this case blue soldiers. They can also be super helpful in determining a price reversal following a downtrend, but that's another topic. Let's play a replay tool on quickly, and now we are seeing the closure of a bullish engulfing candlestick, a strong blue Pac-Man swallowing the smaller red one. And let's say if I add 50 moving average, this bounce over here plus a bullish engulfing candlestick is a super strong and powerful entry for scalping or swing trading. And as an ideal entry, a long position can be made at the closing price of the second candle, so the bigger blue one, and an ideal exit point for this case would be identified by drawing a line of a resistance using previous price action, like in this example, leading us to using 1-to-1 risk-reward ratio. So of course you can use the same logic for the bearish engulfing candlestick pattern as well. Just make sure you enter on a fully closed candlestick for stronger entry confirmation. So the last one, but definitely not the weakest pattern I would like to cover, is the three black crows pattern. Now this pattern is powerful if you can recognize it properly. The three black crows candlestick pattern is a reversal pattern found at the end of an uptrend. Because it consists of the three candles, this pattern nearly entirely verifies that a reversal is taking place at this time, as there is a significant amount of a bearish force behind the formation of this pattern. So the black crow pattern is made up of three consecutive long candlesticks that have opened with the real body of the previous candle and closed lower than the previous candle. This pattern and its candlestick have small or no bottom wicks in the majority of cases I have seen. So for example, over here we are seeing a strong trend towards an upside, multiple rejections of the trend indicating bullish momentum, until this moment when three black rows appeared, the first one even bouncing off a defined resistance zone. So now your entry could potentially be based on the last red candlestick, and take profit is calculated from the first candlestick upper wick to the last red candlestick's lower wick and times it by 2 for a potential take profit zone. So stop loss is higher than the first red candlestick, or in this scenario above the resistance as well. Again, the exit point should be based on your overall analysis and the tools you are using to help to determine the exit point. So please do not rely on candlestick patterns alone. So if you found this video helpful, make sure to watch this video next to not miss out.